If you are like many of my colleagues, you may have heard the word syndication, and maybe you even had a couple colleagues or friends who've been involved in a real estate syndication, but you don't really understand what it is or how it works. In this video, I'm going to walk you through exactly what a syndication is, and also, importantly, what a syndication is not, and then we'll talk through what your role as a passive investor would be. Hi, everyone. This is Dr. Danny, the multifamily MD. I'm a practicing full-time family medicine physician with an interest in wealth building and a focus on passive real estate investing as a way to achieve financial freedom. So in today's video, we're going to get into what is a real estate syndication. So we'll start with definitions. Webster defines a syndication as a group of persons who combine to carry out a particular transaction or project. And then it goes through and gives some synonyms that are pretty funny: cabal, crew, ring, gang. But essentially, it's a group of people who get together to do some specific activity. And so in real estate, this would typically be buying a piece of real estate. So the history of syndications, it was actually kind of interesting. I was doing some research this morning, and what I learned is that up until 1933, it was just a free for all. So I could go get a 50 unit apartment building under a contract, and then I could just walk around and ask people for money. I could put an ad in the newspaper. There was no registering it with the SEC. There was none of that. And then in 1933, the Securities Act of 1933 passed, and that really that really kind of changed the game. And so what it did is it essentially just raised the bar a lot on what you could syndicate, how you could raise the money, and who you could raise that money from. And so the whole point of this was to protect the public, right? So you didn't want a bunch of shysters going out there and just collecting money to invest in, deals that were, not very sound. And so, this really changed the game a lot. And I think for the general investor, it was a good thing because all of these projects now are overseen by the SEC. So the only way to do a syndication is to register it with the SEC. You can't just go out on the street and raise some money from your partners and buy a building and call it a syndication. You can do that, and if you know the people and it's just a small number of people, you can do what's called a joint venture. And that would be, basically where I get together with two or three of my colleagues and I say, hey, Dr. Gordon, Dr. Smith, Dr. Annie, let's go buy this 20-unit apartment building. And, we'll all put in whatever we need, $300,000 or whatever we need to buy that apartment building. We write up a contract between ourselves and we buy that building, and we all have different responsibilities for it. And that's how it goes. But what a syndication is it's a different animal. It is designed to be run by one group, and the money mostly comes from another group. So the way that would look most of the time is you would have a sponsor, and the sponsor would be the one who finds the deal, puts the deal together, jumps through all the paperwork to get it registered with the SEC, and they are the ones who are going to be doing all of the work. And then the other group of people are the investors. And so, this would be, me or you or any person who is interested in putting money into a real estate syndication. And so that group of people, the only work they would be doing is just sending a wire for, whatever amount of money that they decide. Most of these deals is typically 50,000 minimum, sometimes down to 25,000. But um, but yeah, that's how it works. And so, the next question is, who are these passive investors? Can just anybody do this? And the short answer to that is no. With that Securities Act of 1933, they essentially said there's only two groups of people that can invest in syndications, either an accredited investor or a sophisticated investor. And this is kind of getting into the weeds a little bit. But the accredited investor is basically someone who has a lot of money. And the SEC says, well, if you lose 50 grand or 100 grand, you're still going to be able to eat. And so the strict definition is, if you're a one person, not married, then you have to make at least $200,000 for 2 years in a row. Or you have to have a net worth more than $1 million. And if you're married together, you have to make at least $300,000 or have a net worth of at least $1 million. So it's the same amount, whether you're single or married. And you have to make that amount for 2 years. So you have to show someone 2 years of tax returns where you're making at least 300,000 if you're married, or at least 200,000 if you're an individual. And so this other group is the sophisticated investor group. And, this one's a little bit more nebulous. The SEC defines a sophisticated investor as someone who has sufficient knowledge and experience in financial and business matters to make them capable of evaluating the merits and risks of the prospective investment. And so that is basically a fancy way of saying you have a little bit of knowledge and experience, and you're not likely to lose your shirt. So that would be, maybe someone who owns a couple single family rentals, and they have some extra money they came across and they want to put it into a real estate syndication. And so that person can invest in certain syndications. And so they can invest in what's called a 506B. And, we don't really need to get into all the details, but the take home point is sophisticated investors can invest in syndications, but not all syndications, only if they're under this 506B regulation. 506C, which is the more common one, because you're allowed to advertise it to the general public, they are not allowed to invest in 506C. But we don't really need to get too into the weeds with that. And then another question that comes up is, what exactly can you syndicate? And, why do people syndicate? So, you can syndicate pretty much any type of real estate. I mean, the main thing that I am interested in is multifamily, because that's what I have the most knowledge about. But you can syndicate industrial complexes. You can syndicate an office building. You can syndicate medical practice buildings. So there's a fund I just saw the other day on Crowd Street, and that's all they do is they own medical buildings and they lease them out to providers who need space for their practice. So you can really syndicate anything. And then the next question is why do sponsors go through all this trouble of registering with the SEC and putting in all this work? And there's basically two answers. One is, if the project is very large and they need to raise a lot of money, then they need a lot of investors. So it's unlikely that they're going to just be able to find those people in their immediate network. And so syndications typically will be, multi-million-dollar investments. So the ones I'm in, they were a 150 unit apartment building, a 300 unit storage property. And, so it's typically millions of dollars, probably, there's no set minimum, but it just doesn't make sense unless the property's at least a few $1,000,000. And so that's one reason, is that they want to be able to raise money from people who all they want to do is put up money. And so they want to buy a security. And really the only vehicle to buy a security and is a syndication. So that's one reason. And then the second big reason is the sponsors get paid for doing this work. So, I'm not going to go through, specific deal structures, but the general concept is the sponsors will typically put some money into the deal. So, pretend the down payment on the property is $10 million. And, so it's I don't know, a 70 or a $50 million property, and they're putting 20% down. So the down payment is $10 million. So the sponsors might put $1 million down between themselves, and then they might raise the other 9 million. And so the way this works is the passive investors who put up that $9 million, they each own a small percentage of that particular project. So, in this case, if I put up $100,000, I own, 100,000 divided by 9 million. So I own a pretty small chunk of it, but that part is mine. So my profits will be based off of what percentage equity I own in that particular apartment building or office complex or whatever it is. And I will get paid off of that. And so a lot of times these will have like a structure. Well, they'll say, okay, once the apartment makes this particular return, whether it's based on cash or IRR or all these terms that, are specific to real estate. But the concept is you're going to get paid as a passive investor. And then if the property does really well, some portion of that money is going to go towards the sponsors. So, the most common split out there is a 70-30 split. So they may say, once your returns get to be more than 5% or 6%, anything above that, 70% goes to the investors, 30% goes to the sponsors, so that they are essentially incentivized to run the property well and make more money. So that is a short overview of what a syndication is. Hopefully that helps just give you kind of a framework for thinking about these things. But at the end of the day, it's a way for individuals, specifically accredited investors for the most part, to be able to own a portion of a real asset and benefit from the cash flow and benefit from the appreciation in a way that you just can't do through investing in REITs or other stock market vehicles. So thank you for your time. If you have found this information valuable, give the video a thumbs up. Also feel free to like and share. For more information about wealth building and passive investing, visit my website, themultifamilymd.com, via the link below in the show notes. And thank you for watching. This is Dr. Danny, the Multifamily MD, signing out.